So I thought we'd start with this chart here, which indicates what I call the battle royale that is currently happening. And this is the battle between investors who believe that there's a global pandemic upon us, which is going to cause a huge global slowdown, which I believe it should. I mean, it is disrupting supply chains left and right, cruise lines, vacations, you name it. I mean, everything is interconnected, right? It's truly a global economy. And this is certainly throwing a wrench into things. You have that camp, which is selling stocks, and then you have the camp that is looking at rate cuts. Basically, we got a very surprise rate cut on March 3rd, where out of the blue, the Fed lowered interest rates by half of 1 percentage point, 50 basis on March 3rd. And more importantly, we have coming up a scheduled meeting on March 18th, which obviously hasn't happened yet. And this is the Fed funds futures, where it can predict the target rate probabilities of what's going to happen. As you can see from the chart here, the current target rate is 1 to 1.25. There is now a 100% chance that they are going to lower interest rates again at 2 p.m. Eastern on March 18th. And we know that simply by looking at the chart. In that, notice there is basically the only thing left to decide is whether or not it's going to be a 50 basis point cut or that's going to take us down to 50 to 75, or is it going to be a 75 basis point cut that's going to take us down to a range of 25 to 50 basis. So as you can see here, there's a 60% chance that that happens. There's a 39.6% chance that the other happens, but there isn't any chance that we stay the same. Usually what will happen is if the current target rate, if the odds are say 100% that nothing's going to happen that week, they'll just show you the current target rate as one of the bars, and they'll say that it's 95% certain that rates won't be moved, basically. So in this case, we have a 100% chance of something's happening. Only question is how much. So that essentially is those essentially, I should say, are the two factions on either side of the battle royale. I made this joke the other day in the Squawk Box when I was guesting for Brad, or it may have been actually in the pre-market perspective, I'm not sure, but I said that it reminds me of the Miller Lite commercials from the 80s, and I'm probably dating myself, but where they would say, tastes great, less filling, and the two sides would be yelling at each other. It's kind of like that. You have people that are stepping in to buy the market because they think the rate cuts are bullish. That's why you saw the huge swing up on Friday afternoon. I'll show you that chart in a second. And then you have the potentially longer term sellers that are selling the market because they fear that earnings are going to be depressed in subsequent quarters. All right, let's get to some charts and take a good look at what we're looking at here. We're going to start with the S&P like usual. So I do believe we're going back to this low here, which is also the same low as the February 28th low. I call it the swing low. It was the first low that was made from the big move starting from the top. And this particular week that just passed was very, very interesting in that we had a trend line break. Basically, a lot of the week was made up of a lot of choppy action, which is basically just balancing. I like to always remind people that prices do not move in a straight line. A lot of times people will see price action like this with these big candles up and big candles down, and they'll be very, very frustrated by it because it can kick them out of like longer term positions. And the way to play stuff like this is basically just to keep your stops a little bit looser and lower your expectations about how fast things are going to happen. When you're in a more trending environment, right? When you have, let's say, a situation like this, right? And the market's just going up and it comes in, moves up again like that, you are basically getting paid like right away, right? Think about it. You're hopefully smart enough to know that you should be biased to the long side, and you put on some spreads or you buy some stocks, and it feels like you're getting paid right away. The next day you get paid some more and again until you reach your target. Whereas when you're in a situation like this, basically there is a little bit more pain to be had, and it really kind of separates the more experienced traders from the newer traders, because these are the types of environments where the newer traders tend to blow up. I know that when I first started trading quite some time back, these types of environments would be very tricky because I would be just too focused on the movements that were right in front of me and not kind of stepping back and seeing it, okay, this is part of a larger balance area. One of the ways that you can keep things in perspective of where you are, whether it is really a rally that's going to go back to the all-time highs or it's just going to fall apart, or it's just a balancing area like we had here, is simply to use the Fibonacci retracements, which I talked about endlessly over the last couple of weeks, showing people that we crested right here at the 50. We never made it to the 61.8. So that's basically pretty bearish. Remember, a stronger market will bounce all the way to the 61.8% resistance, Fibonacci retracement level rather, before turning around. And then my general rule of thumb is that if one daily candle closes above that 61.8, then you have a good chance of going all the way. Basically, the market's probably not going to roll over some more. So S&P basically did what it should have done, went right to the 50. It actually did it twice. That surprised me a little bit. I thought that just the one touch here would have been enough, but it tested it twice. Then you had a gap down here on Thursday, and more importantly, what happened on Thursday was very noteworthy in that we crossed below the uptrend line and closed there, and then of course Friday was a gap down. Now, as I was saying, on Friday there was a huge rally late day, and what does that tell us? This is essentially the battle royale that I'm talking about. This happened because a Fed president, I think his name is Rosengren, came out with a statement and said we need to be doing more, basically, or basically said, there are other things that we could be doing besides rate cuts. He's trying to basically open up the arsenal of things that they could be doing. It was some comments along those lines. The specifics of it are never really important. Remember, it's all about how the market reacts. Even when the Fed lowers or raises rates or keeps them the same, right? Think about it. What they do doesn't matter. It's how the market reacts. That's the way you should basically treat all economic data, or all punditry, which, as I call it, from the FOMC, right? Anytime anybody there is talking or running their mouth, just take a look at the futures. If the futures are reacting, then you got to go in the right direction. If not, then it's really meaningless. So obviously the market did take this to heart on Friday and rallied quite a bit into the close. Now, in doing so, did it break up the pattern? I don't think so. I don't think that anything happened in terms of the pattern. We still have an unfilled gap above us here, but I think the pattern is intact. And what I mean by that is that the market still wants to retest the February 28th low, which is this swing low, which also ties in with this September or I think early October, October 3rd low, basically back here. Okay, that's where I think the market is going. Now, could it bounce a little bit more before doing so? Yes. And why? Because it is the dastardly H pattern. I talk about this all the time. What does H stand for? Hell if you're short, basically. If you're short, it just wreaks havoc on your position. The H pattern is often formed when the post of the letter H is very, very steep. When you have a big move down, that's how you form the H pattern. And then because that move is down so big, the ensuing rally that corrects a little bit of that move is of the rip your face off variety. And usually it doesn't just roll over straight, it has this big crazy action. And when it starts to come down, it does so begrudgingly, as you can see on Friday, where everything was going hunky-dory for the shorts, myself included, and we were just going down to the lows, and then boom, like last 45 minutes of the day, you get this news that the market construes as bullish, and you rally right back up. Part of that is because of where you are, because of the H pattern. Basically, in a nutshell, once the market does this, has this huge move down, it's very hard for it to retest this area. It wants to retest the area, but it's hard for it. I talk about this very often in terms of swing trading. I will mention the phrase, it's a hard pattern to get lower out of, for instance, right? It's where people will send me charts and say, I want to short this stock. And I can tell right away that even though that stock might eventually go down, it is not a good candidate for a short setup, because I know that it is going to frustrate the trader, because I've seen this movie so many times before. It's what I call a hard pattern to get lower out of. Okay, basically. So it's, it may be at first glance a bearish pattern, but there's a number of patterns like the H pattern which are difficult to actually get lower out of, even though maybe you eventually do, but not without living through a whole lot of chop. Okay, let's move on to other averages while we're still talking about the majors. The NDX, I've put the same 50% fibs on it. We just breached it a little bit before rolling over. NDX still has the same amount of room to go just to here to the Feb 28th low, but we should note that the October 3rd 2019 low is quite a ways away. So this is also, I should say, thinking ahead, this should be giving you some market generated information that you can use when you may or may not be looking to get into certain stocks for a bounce. NASDAQ 100 stocks are probably going to outperform back on the upside when the market turns and gets some buying pressure back into it, because they have been showing relative strength all this time. The NDX, as you can clearly see from this chart, as compared to the other one, is so much stronger than the NDX, than the SPX rather, because in in relative terms, where is the SPX sitting? Somewhere right around here, right? It's very, very close to the October 3rd low, but you can see that the NDX is above. All right, last but not least, I always like to spend a couple minutes on the Russell. The Russell is showing a lot of relative weakness and is potentially going down to this low here, which is, again, this is a different, this chart is different, so it's more like a late December 2018 low, right? This, obviously the different indices are different. We've taken out this low, probably fills up this area, but the main thing that I look at of the rut in terms of not really being too concerned about its longer term pattern or where it's going is I like to think of it as a risk on, risk off type of barometer. You can see that the bounce was not as strong. It also cleared this prior low, which the other indices didn't. Therefore, it's relatively weak. Therefore, I think the Russell is acting as a leader. Remember, these are the more small cap, riskier names. When money flows into the rut and out, when there's sector rotation into smaller caps, out of large cap or tech, that is more of a risk on environment. I believe this is more of a risk off environment. So for now, the rut is telling us that, it's all systems go for the bear. Okay, in the last part of this video, I'm going to continue to look ahead and we'll talk about where I think things go from here. I've already kind of alluded to it, but before I get into that, I just want to talk a little bit about market internals. This is what you're looking at here, what we call the quad, because it's 4 charts. This is the bedrock, if you will, of the ShadowTrader methodology. I literally stake my life on this. This is something that I came up with about 15 years ago or so, and I have been using it every day since. This is what we teach all of our traders in the ShadowTrader Squawk Box, and I literally have 1,000 emails of people telling me very simply that these charts have changed their life. I'm not going to go too deeply into it. In this particular video, I do have lots of market internal videos on YouTube. Just do a YouTube search for market internals. But what I do want to talk about in this particular video, and I mentioned this in a lot of videos, is whether or not the internals have been confirming the moves that we've been having recently. And I believe that they have. These bubbles up here are the breadth. We've been opening on large gap downs to breadth that has been in like the 15 to 1 negative all the way up to 18 or 20 to 1 negative sometimes on the open. That's pretty bearish. Now, obviously that adjusts itself as the market starts to trade. It usually doesn't hold those very bearish levels, but the numbers have been really solid to the downside as far as the breadth. The breadth is, of course, the relationship between the volume flowing into up stocks and the volume flowing into down stocks, and I think it has been confirming. The next thing is the advanced decline line, which has also been confirming. I talk a lot on the advanced decline line about certain levels that are key, and one of the levels that's very key is this one here, which is minus 2,000. And basically, when you have a minus 2,000 or below, you can see even here it's a lot of activity way below the minus 2,000 in the advanced decline line, and this is on the New York Stock Exchange. That is really a signal that sellers are stepping on the gas full and they're on it. One of the tricks you can use, this is a really good tip, is if you think you're going to have a trending day down, for instance, and you want to put on a short as the market bounces back up to the 20-period moving average or up to some trend line or whatever, that generally works really, really well on days when the advanced decline line is what I call pegged. And pegged means that it's at least, less than or equal to 2,000, right? And it's just bumping along at the lows, okay? Meaning that it doesn't look like this, where it's all over the place and it comes to the zero line. It opens very low and it stays hovering just around the minus 2,000. And usually, instead of having a pattern like this, it just has a pattern like this. It's just a straight line across. I call it pegged, when it's just pegged on that 2,000 number. So remember that. This is an important note for intraday traders. When you see that number pegged, you should have utmost confidence that you can pretty much short any rally, any lift in stocks, no matter how small or even how large. If you get some big lift come out of nowhere, very often you'll get a lift like that and you'll see that the advanced decline line did not budge. It just stays pegged. And that's how you know that you have that negative divergence going on, where the price is rising but the advanced decline line is not. Voila, basically the market is serving up an intraday short to you on a platter. Okay, so remember that. Okay, last but certainly not least, the ticks. You can't glean too much in terms of longer term bias for the day from the top part of the chart, but you can from the bottom part of the chart. This is basically the cumulative tick. This is an indicator that we sell on our site, and I've found it to be extremely useful. And basically this also is one where you want to be looking at absolute numbers. You want to be looking also a little bit more at pattern and how I call it the concept of building. Whenever I talk about the cumulative tick, I call it building. So what I mean by building, it's either building from the upper left to the lower right to the downside, or it starts to build from the lower left to the upper right on the upside. All right, and basically that should be obvious, because since it is a cumulative tick, every 15-minute period it is adding on whatever the net ticks were in the prior 15-minute period. It's adding on. So obviously on a bullish day, you have that sort of building to the upside that is confirming the buying pressure, and on a bearish day you have that building to the downside that's confirming the selling pressure. In addition to that sort of building pattern, on days that are very weak, when you see numbers here that are like sub 5,000, usually in the cumulative tick, 3,500 to 4,000 is my first line in the sand, where it's either super bullish or super bearish. So this will tell you a lot, that on Thursday you were building right into the close. You had the building pattern where it just got bigger and bigger, and you ended the day at sub 5,000. That is important. Okay, it was not as bearish on Friday, but got down to about minus 2,800 or so. So keep that in mind. Cumulative ticket, I think, has been confirming a lot on some of these bearish days, and I do keep that in mind. Okay, so where are we going in the future? Let's maximize our chart here. Let's go back to the S&P. Again, this is pretty simple. I've been saying this for a while, that I think we're going to retest the Feb lows. That's not that big of a prediction. It would just entail what I call filling up the triangle, right? If you call this a triangle, filling it up means you're going back down here to the base. But in the bigger picture, a lot of people have been asking, well, where could we go, right? Where's the next support underneath it if the market was to really fall apart? And for that, you really have to go to the monthly charts. You put it on the longer term charts. And from those charts, it's really kind of scary, because you can see the dominant channel here, which is multi-year, okay, which has is going all the way back to the 2009 low. If you connect these first 2 points, right, that is the dominant channel that we've been in. That doesn't find channel support until 2600. And if you look at the chart, probably a couple months of selling to get us into there. Are we going there? I don't know. I have no way of knowing that. I'm just trying to show you that if this market was really to accelerate in terms of selling, if the in the battle royale that I've been talking about, if the pandemic global slowdown beats out rate cuts, and you can be sure there will be rate cuts. I already showed you that there's going to be more rate cuts on March 18th, and don't think there can't be more rate cuts after that. They may take it down to 50 basis, and they may cut it to 0 after that. They can certainly do that. So we do have a ways to fall if the rate cuts don't, have any effect on the market, and we're ready to come down a bit more. Just be aware that the S&P would not bottom out till about 2600, which is like another 300 points lower than where we are now. All right. Last but not least, trade ideas. I got just one sector to focus on that has been extremely destroyed, and some of you may know exactly what I'm talking about, and that sector is cruise lines. The cruise line stocks have been absolutely battered, and in percentage terms, they've been taken down, like some of them 70, 80%, whatever. You can do the math yourself on the charts, but look at some of these. This is like CCL, Carnival, I'm putting it all in the monthlies. Notice that it has strong support here in the roughly $17 area. The stock was 73 not that long ago, a couple of years ago, and now it is 25. So it has been cut literally by 2/3, and this support is still coming here. So some of these I think are going to be a buy around these levels. So keep that in mind. It's more of a longer term hold, but if you could, if we do have another leg lower, which according to this monthly chart doesn't even look like it would take a full month to get down here, potentially you could have a good long-term buy. CCL is one of them. RCL is obviously another. That chart looks a bit stronger. I have noted that it is actually at trendline support now. So if you are so inclined, you may take a flyer on this now, and you obviously know where your stop is, and you have pretty darn good risk reward under the current swing low. And NCLH, Norwegian, is another one. This one also is quite bearish. Notice how much of this move has been taken back all the way down to this 24 area. Stock was about 65 recently. All right, so keep that in mind.